hello there. Welcome. And I don't know what I was going to say. Good morning, good evening. I don't actually know what time I'm going to upload this. Wherever you are in the world, hello. So start off with the usual disclaimer. Straight off the bat, I don't know what I'm doing. Okay, I have no financial background and I have no financial qualifications. I'm simply a bloke who's trying to vlog an educational journey, my educational journey towards hopefully becoming a successful investor. So this video is for informational purposes only and does not constitute investment advice. Any opinions formed during this video are my own and not recommendations and are subject to change without notice. Please do your own due diligence and consult a licensed financial advisor before taking any investment decisions. Right, so that out the way. At the end of the last video, I came across this one on my screener, and we read here, the stock plunged 71% after losing a major contract. Well, that contract, I think it's in this one here, only... Is it this one, or was it a different one? There you go. The contract that accounted for more than 10%. So I don't know what more than 10% is, because obviously anything up to 100% is more than 10%. But if it was more than 20%, they'd say 20%. I think if it was more than 15, they'd probably say more than 15. So, basically, around about 10% of the revenue has gone from one contract. Losing one contract, but the price has dropped 71% from that. So we're going to look into that and see what's going on. I don't even really know what this company does actually, but we'll Google it. We'll run it through AI. I use quite a lot of AI to help move my answers, so we'll do that and we'll see what happens, see what we can come up with this, because this is very similar actually to some. It's not, all right, because we haven't looked into the company, but it just like rang a bell with me in that Lilu's Joel Greenblatts, Lilu's Columbia Business School lecture, he spoke about when he invested in Timberland, and Timberland absolutely tanked. And when he looked into it, it only lost like 10% of its revenues. I think there was an Asia crisis or something like that had happened, and Timberland had lost 10% of its revenues from that, and the price absolutely tanked. And I just thought, oh, there's some parallel there with this. Not Timberland was still a good business. We haven't got a clue if this is a good business, but just the actual incident of what itself is. I thought very similar. You know, you've lost 10% of revenues and the stock tanked 71%. So, you know, there could be something in it, so we'll look into it. The only other thing I wanted to mention as well is that I said that I had a document with average industry multiples and all that on it. I do. I found it. I knew I had one. I found it. Here, I've actually got a link. I think it's something that Aswaf, is it Demorduran? It's from his website, so I just put it into here because I wanted it all in one easy find place, even though it took me ages to find it. And I think I've done a few other things myself, put a couple other things in. This one I know that I'm doing myself, and as I'm coming across an industry like it and asking, I'm having to fill it in. So yeah, anyway, there's a document that I thought I had, but I couldn't find, but I do have it. It's there. So here we go. So I have already pulled up the balance sheet for this Verra Mobility, but first of all, we're going to figure out what the business does. One of the other things I'm quickly going to do, I've got to watch a bloody advert. The other thing I'm quickly going to do is just see what the inside of buy-in is like on this. VRRM, none. So I don't like that. But it might be worth keeping an eye on, seeing whether or not anything happens now. The price is so low. It's a bit of a red flag for me though if it stays this low and nobody ever does, you know. We're not going to see any new buy-in at these low levels either for this, because it's just not gonna show up yet. Sun River 7.11% is the highest amount. All right. Anybody else I recognise? No one. No one. Okay. Well, let's figure out what this business does. Figure out why it's so cheap. Why it constitutes a 70% drop in price just from losing 10% of revenues. We'll go from there. Right. Leading provider of smart mobility technology solutions focused on making transportation safer, smarter, and more efficient. Company develops and operates technologies for automated tolling and violations management. Okay, and parking management serves commercial fleets. Yes, it doesn't really explain what it does, so we'll ask you to go deeper. Maybe give it an end-to-end thing. Verra Mobility operates a primarily recurring contract revenue model with high service revenue, typically 90 to 94% total revenue. It combines hardware, camera, pay stations, transponders. Okay. Commercial outsourced services for fleets reduces end-to-end. So, what's this? 3 areas. Commercial outsourced services for fleets. Yeah, I still don't really understand what it does though, so what's going on here as well? I haven't finished answering the question yet. Alright. Hopefully Grok's working. If not, we'll just switch over to ChatGPT. Because Grok wasn't working the other night when I tried to do this, unfortunately. Explain end to end the business. If I was a customer, what am I purchasing? What do they supply? And how is it produced for me? I don't know. Didn't really know how to ask there. And back part of that question, but so operates an end-to-end smart mobility technology. So as a customer, let's not skip too much. Combines hardware, cameras, software platforms, integration with authorities, back office operations. So it does that just now. Model primarily recurring and contracted. Okay, it's giving me a hell of an answer. Look at the bloody sidebar going up and up and up. Features high margins due to scale and processing millions of events annually, sticky long-term contracts, and install base. It generates ongoing volume. Okay, you are buying outsourced automation, compliance, risk reduction, convenience, and/or revenue safety outcomes for vehicle-related workflows that are expensive, error-prone, or resource-intensive to handle in-house. Verra handles technology operations, integrations, and ongoing management. So, by segment, what Verra supplies and how it works end to end. Commercial services, fleets, rental car companies, outsourced toll payment, violation handling, titles, related compliance services. This reduces administrative burden, late fees, violations, total cost of ownership. So toll management, transponders, devices nationwide, real-time payment to authorities. Okay, but okay, hang on then. Violation processing, handles parking toll, photo enforcement tickets. How it is produced, delivered for your vehicle, rental or fleet passes a toll or incurs a violation. License plate transponder captured. Verra's platform receives the event via integrations with 50 plus toll authorities and 600 users. So automated machining, matching, validation, violations for drivers. Verra pays the authority promptly for tolls or process citation. You or your customer receive a consolidated invoice report. Disputes handled automatically where possible. Data analytics, reporting and insights to optimize fleet behavior, pricing model per transaction fees. It's a government solution. What you purchase, automated traffic safety enforcement programs that improve compliance, reduce crashes, generate citation revenue, which often stays with the jurisdiction, and handle the full administration load. You retain legal authority. So, hardware, fixed mobile cameras for speed, full program management, installation, event processing, evidence package. So contract, site selection and camera installation. So they supply the cameras then, do they? Camera captures high quality images, secure upload to Verra's cloud platform, automated Verra provides reporting program, parking solutions. What you put integrated parking management platform to boost revenue, reduce costs, improve user experience. What Verra supplies software permitting payments, mobile enforcement, hardware, pay stations, access control. Deployment of hardware software at your locations. Parkers use app, kiosk, or license plate. Overall production and operations backbone. Verra's platform is the core. It integrates hardware, data, operations are scaled. So it's all to do with vehicle SaaS. So it is all to do with vehicles and infractions. A rental company will employ, Verra to monitor and handle any infractions committed by said vehicle whilst leased. Double T. Also, they supply speed cameras, AMPR, and handle infractions for the government or for governments. And what's the last one? Parking. They also supply parking meters and so any infractions related to this. Oops, spelled government's wrong. Let's see if I'm right. Let's see if I've got my head around this. Yes, that's a solid high-level summary. Verra's Mobility's entire business revolves around vehicles, identifying them via license plate, transponders, etc., and associated transactions, compliance payments, and enforcement actions that comes with operating them. Here's a precise breakdown of your points. Rental car companies. Yes, a rental company hires Verra to monitor, handle, mitigate tolls and infractions committed by their vehicles while leased to customers. When a rented vehicle incurs a toll or violation, parking ticket, red light, speed camera, ticket, etc., the ticket often goes to the rental company's registered owner. They use their system to intercept these, match them to the specific renter driver, bill the customer, manage disputes, and reduce the rental company's administrative late fees. They also provide toll transponders, devices, and consolidated billing. That is part of their commercial services segment, a major recurring revenue stream based on transaction volumes. Okay, so government. Yes, Verra supplies, installs and operates and maintains automated enforcement systems for governments. This includes speed cameras, red light cameras, school bus stop arm cameras, bus lanes, MPR. Verra provides full program hardware, software platform, 24/7 operations, evidence review and citation processing. It's a big company then. In thousands, they got 47 million in cash. I'm just looking. That's dropped significantly, mind. Year on year, government to keep the enforcement authority, and often the citation revenue. Verra gets paid via service fees, maintenance contracts, or program management. They manage a large share, around 70% in many US. These programs is a safety focus, reducing crashes, but also generates revenue. Okay, parking solutions, mostly yes. Verra supplies parking management technology, modern parking meters, pay stations, license plate systems, permit management. They help parking operators, universities, municipalities, hospitals enforce rules by identifying unpaid parking, expired permits or overstays via LPR. What's LPR? Then issuing and managing citations. It includes payments processing, appeals collection. That it is not only about infractions. A big part is enabling smooth payments and operations to prevent violations or boosting revenues. The overall theme, virtually everything ties back to identifying vehicles, capturing events, processing the full life cycle, providing hardware, software, and managed services. Okay. So that's more understandable now, alright? I feel like I've got the gist of the company anyway. It's a good thing about AI is that if you haven't got the gist of it, you just keep asking questions and you will eventually get to it. I know, and I firmly believe this as well, that Warren Buffett, Monish Pabrai and all that said if you don't understand a business, put it in a too hard pile. And I'm a big fan of that. I do believe in that strongly. But the advent of AI has made it a lot easier to try and understand the business should you wish to push far enough. That's what I found. I mean, we're a quarter of an hour in now, and we've only just understood the business, which obviously would go straight into the too hard pile normally, but I just want to look into this to some depth just because of the huge drop in price, just simply from losing one contract. So yeah. I'll tell you one thing I haven't done though at the moment is dragged into the spreadsheet. So what I'm going to do, let's just ask this, and while it's filling that out, I'll drag it in the spreadsheet. Recently, Verra lost a contract that was circa 10% of revenues, and it massively hit the stock price. Tell me about this contract. One of the things you have got to be careful of though is that the more questions you have to ask, you're going to end up hitting a limit on Grok, which is why if you're going to use AI and you're going to use it free like I do, I have a ChatGPT account, I have a Grok account, I have a Google Gemini account, because when this one tells you that you can't ask any more questions, you can go on to the next one and ask questions. Just play them all off against each other, you know. Right, get this up. We are looking for Verra. Was it VFFR? Is that right? Nope, not VFFR. What was it? VRRM, not even close. VRRM. Let's drag it in. Right, where are we? Here. This one to this one. Delete. That's the last thing we looked at. Boom. Boom. Oh, wrong one. Boom, in there. Okay. Oh. There's some things on this straight off the bat that I don't like, unfortunately. Book value and tangible book value being negative. Not good at all. I don't like that at all. Simple free cash flow, 59 cents a share. Now it's trading at what's the enterprise value a minute as well. Enterprise value is not much higher, so it's not an overly large amount of debt, I'm guessing. Total debt is 73 million. So less than 100 million, which is it's only, so it must okay. Get your words out. 73 million, and what have they got in cash? 47 million in cash. And they earned 90 million in free cash flow last year. That's dropped massively, mind. Return on capital 50% has been higher. So relatively strong business from that point of view. Simple free cash flow dropped off a cliff. Still really good though, 20%, almost 20%. That's like buying the company back within 5 years. What's the EV free cash flow multiple? 7.6 on current. Okay, interesting. I said this I don't like at all. We'll have to go through the balance sheet and see what we can see. Gross margin's very high though, and has improved. So I was listening to a podcast the other day, and there was a hedge fund manager on there, and she was saying that they use return on capital and a high gross margin to see whether or not the business has got some sort of longevity to it. Obviously, the higher the better, and that's improved. In fact, it's the highest it's been ever. It's 90% average 3 years. This is. And revenues have gone up as well, but they've just lost 10%. So, but then we know they've lost 10%, right? In which case we can give ourselves a figure for estimated revenues, I guess. Let's have a look and see. Verra Mobility's major agreement with Avis Budget Group, a key rental car company customer. May 2026 after market close, termination effective. The contract represented more than 10%. It was a significant portion of the commercial services segment. So it reduces revenue by around, we'll say 150 million, right? And it reduces profit by 130 million. Okay. The revenues, we'll say 150 million. So we'll knock 150 million off of there. We just go to 800 million, shall we? Be conservative. If you're doing any future discounted cash, let's just do it now. Where am I going? This one here. Let's say 800 million. Boom. Right. Got that in there already. Let's keep reading. Total revenue guidance down from, so that's even higher than what I've got. Look, because they're still saying issued with the announcement. Avis was one of Verra's largest customers in a rental fleet toll, along with Hertz Enterprise and major government clients. This was primarily toll management and violation processing for Avis's rental fleet, exactly the outsourced service we discussed earlier. Yeah, Avis's rationale, it could bring much of this capability in-house, aided by technology advancements, AI here. I thought that could come up. This raised broader investor fears about Verra's moat in commercial services. Okay. Shares plunged 46 to 71% depending on the exact intraday low point. Well, it closed here. And it opened up here. So where are we going to say? There to there. Still about 60. I can't get it in the right place. 65% down. Interesting. The move reflected both a direct revenue hit and fears of similar losses with other rental customers. Okay. Renewals with Hertz Enterprise coming in 2027. Verra's response, immediate cost cuts and resource reallocation to other customers. Reviewing contractual IP rights and negotiations. CEO expressed being surprised, disappointed, emphasis on the strength of the broader platform, innovation and growth in other areas. This event underscores recurring but not guaranteed nature of large commercial services contracts. So what did it say they did it? Avis indicated it could bring much of this capability in-house. Okay. So, what are Verra's revenue, segmental revenues? I'll probably find that out on here, to be honest. This is only a 10Q as well, so this is a quarter. Let's have a look. Commercial services, 45%. 44.5, 45%. Okay. Dear. Let me break it down. Let's have a look. Opening action, thank you. So they still got one with Hertz. Not in there, not mentioned. Oh, Avis, not mentioned. Okay. It might not be broken down in the 10Q. It might be more of a 10K thing. What have they got? Description of business. They got a breakdown of the revenues. Accounting policies. Right. Hang on then. Income. So 233 million total costs and expenses. So hang on then, how is gross margin so high? Cost of revenue 25 million. Cost of revenue, not got the right one. Cost of revenue in the last quarter was 7 million. There. Cost of service revenue, excluding depreciation, cost of product sales. So they haven't actually got the full costs in here, have they? Because I would add that into it as well. Okay. We need to try and find a revenue breakdown. Unless this can tell us. Down 4%, up 3%, up 2%. Commercial services is heavily tied to rental car companies and fleets of toll violation. 10% of Verra's total revenue is expected to reduce analysed commercial service revenues. Oh, wow. So that's a quarter. So Avis was 1/4 of, spell it right, commercial services revenues. Yeah, yes, approximately. Avis represented roughly 30% of commercial services revenues. So, okay. So, what are Hertz and Enterprise contributing to revenues? Because they're going to go as well. Interesting, huh? Verra does not always break out collectively, and roughly 35% of 80% of commercial services. So, oh wow! So if they lost all three, these figures are full year 2025, when the three largest together drove total revenue. Wow. Hertz and Enterprise contracts are scheduled for renewal in 2027, so investors' focus has now shifted heavily to those. Did they say that commercial services was the biggest portion? 50%. Didn't say it there, did it? But I had to ask it to break it down because it didn't bloody do it, did it? Or have I seen it before? There we go. No, hang on. That's not there, was it? Okay, yeah, it's not there. Break down Verra revenue percentage by segment. Human. $44, $47. Okay. Do we know which segment's the most profitable? The only thing I will say is that relying very heavily on AI here, commercial services, easily the most profitable. Highest and most stable, but they're going to lose almost all of it. How much were they? Wow. So what were revenues last year? We're in Q1 at the moment, I think, are we? Yeah. Hang on then. Just under $1 billion. So 300 million revenues. Jesus Christ. It's not fatal, is it? But bloody hell. Yeah, it's not fatal, but it's huge. Certain enterprise contracts are scheduled for renewal in 2027, so investors' focus has now shifted heavily to those renewals and potential in-house moves. This level of concentration is why Ava's loss caused such a sharp stock reaction. The remaining two are now even more critical to the segment's stability and profitability. Verra has highlighted long-standing relationships and platform. Okay. So what are they saying? Where was it? Did I not have a bloody I thought I had a table. Oh, I didn't go up high enough. Did I not? Where was it? No. What? Oh, it's here. How did I not see that? Maybe I wasn't low enough down. Profit margin 63%. Oh. It's starting to look pretty fatal, isn't it? If we're honest. Let's dissect the balance sheet. I don't think the debt is too much of a problem. It says there's no preferred stock. But they can authorize 1,000, but there's none issued. Okay. Oh dear. Debt net of current portion. So was that 1 million? No, 1 billion. In thousands. What have I got then? That's not right, is it? Total debt, long-term debt 394 million. Total debt 73 million. And yet here, well, the right thing, yeah, balance sheet. 1 billion in debt. Where have they got their 73 million from? Doesn't add up, does it? I am starting to be turned off at this company, I've got to be honest. What is the general consensus towards Hertz and Enterprise also leaving? You don't know that they will. They might sign shorter term contracts to find out how that Avis gets on. Right, what is, while we're here, how much debt does Yahoo Finance say they've got? Total debt $1 billion. Why the fuck is my data saying 73 million then? It's very, very clearly wrong. Oh, look. It was right. And now it's wrong. Let's have a look at the balance sheet then. Is the data wrong? Short-term debt, 34 million. Long-term debt. There and there. Well, that's wrong. Wrong. What are we saying the debt is? 166. And what is it on here? 1021. Right. Current portion of debt, 34130. That's correct, isn't it? Short-term debt, 34130. Long-term debt is wrong. So long-term, no, hang on. We can swap it out. Long-term debt is 1021487. 1021487. 1021487. 123. Boom. There we go. Now what have we got? Does that change any of our metrics? Probably not. There you go. Enterprise value's gone way up. Ooh, so then the multiples have gone way up. Why is this multiple not gone up? Because it's the market cap. Oh, God. F60 to F47. 60 there. That seems more in line with everything else that we're reading, doesn't it? Total debt. Have they got enterprise value on here? Summary. Enterprise value. No. Not in financials. In statistics. Enterprise value. There you go. 1.73 billion. Currently. That's because the market cap's dropped so much. I was wondering why it dropped so much, but it's because the market cap's dropped so much. 1.73 billion. What have I got it as? 1.69. So we're in the same ballpark. All right, you just got to be in the same ballpark. Oh, God. It was looking so beautiful, wasn't it? Because now, let's read what the consensus is on. Here we go. Your renewal risk is now a major overhang. Hertz and Enterprise contracts are up for renewal in 2027. Yet expected Avis termination. Unexpected has shifted sentiment from assuming high stickiness to question whether the other two large rental companies could follow suit. Analyst downgrades reflect this fear. Downgraded Verra post Avis news, citing customer concentration. Price targets were slashed dramatically, often to the $4 to $9 range. This is where we are, $4.51. Several analysts explicitly noted that losing one or both would further threaten viability. Market pricing the stocks immediately after the reflects fears. Broader Avis in AI automation, international systems, large. I thought that when as soon as it mentioned software's being pummeled by AI, isn't it? By AI fears. Not all views assume automatic losses. Some see the Avis case as potentially idiosyncratic. Verra CEO called it surprising amid ongoing. Verra is emphasizing platform value cost. Okay, government solutions is now the largest segment. Parking and viewed as more stable. Few longer term bulls argue the panic may be overdone if Hertz and Enterprise renew or partially renew. So I'm saying Hertz Enterprise may renew. Give it a year to see what Avis come up with. Then overall, the prevailing views is negative to neutral. I mean, I'm a value investor, so I have to be very pessimistic on this because I can't see anything at the moment that looks good for the future. I can't see anything that's potentially looking at it as overblown. You know what I mean? It's the highest profit margin portion of the business, and there's potential for them to lose basically all of the income from it. Prevailing view is negative to neutral. This is fast moving situation. Okay. Okay. Let's just have a look at the simple free cash flow because it's fallen off a fucking cliff. Why? What's happened in here? $40 million. Just in installations, 31. It was cheaper before and they had more money. Year on year, look. What was the revenues year on year? Comprehensive income. Basically the same. So what's happened then? Costs have changed. SG&A's gone way up. 12 million. No, hang on. Not SG&A operating expenses. SG&A's down. That's sort of offset then, isn't it? Operating expenses up by 12 million. SG&A's down by 10. So there's only like 2 million difference. 2 million difference there in depreciation. Cost of revenue's gone up by 3 million. So there's a differences right in there. What? Income from operations. Interest expense down. So is debt down year on year? What are we? Debt. No. It's up. It is up. See if anyone says anything on this. What was it? VRRM. By May the 20th. When was this announced? Solid visibility into long-term growth. Oof. Oh. When did this announcement happen? It says so here somewhere, didn't it? Because they said it was a surprise. So I literally just read it. Called it surprising. Okay, there. Okay. When did they announce it? What day? Here. 26. That was after that bloke wrote his article. So things have majorly changed since then. What's the comment say? Is anyone? Trend was indeed your friend. While you're correct that purely from a mathematical standpoint, 70% drop is disproportionate to 10 to 15% loss in revenue. It appears a bigger issue in the market is factoring as the various customers are nowhere near as sticky as some believed. In others, if Avis felt comfortable ditching Verra, it means they found a more effective, cheaper partner, and other big rental companies may follow suit. Yeah. Oh. Aged well. Mocking the poor guy. Yeah. $16 to $14, 22% undervalued. So for me, that's not even worth looking at. It's not. Oh, do we continue with this? Do we continue with this? So our figures are way off now. Let's have a look a minute. Free cash flow has dropped significantly year on year. why. Let's just see what Y Sheets has basically saved my life. I use Y Sheets put away for my data, so I'm not going to say hardly anything bad about it. It's made things so much easier for me and so much faster, but I would like things to be broken down more into more segments here and there, you know, because there's more to it than what they put it into. And as well, the only other thing as well I don't like, and Roaring Kitty moaned about this with Sharadar, is that operating leases are now counted as debt, as if it's hardcore debt, which isn't actually the case. It'd be nice if that was broken down, because you have companies that have way more leverage than they actually are. But there we go. What was I looking at? Cash flow. So year on year, it's down by 20 million. Costs are up massively as well year on year. Oh, way up. So they invested heavily. Let's have a look. That's significant. That's where your free cash flow drops potentially come from, if the figures are correct. Decline 77. Main reasons: decline stems from both operating cash flow and higher capex. Yeah, so it could be right. Increase in unbilled accounts receivable. They're saying there's some working capital reason as well. Higher inventory build-up in government solutions. Weather-related delays. Also purchased but not yet installed. Okay, lower net income. Adjustments. Higher capex. Capex rose to 31 million from 21 million year on year, primarily for government solution cameras. Okay, these are described as larger temporary timing. I can see that as well, because once they're up, providing nobody damages them, they're, you know, it's driving higher near-term capex and inventory needs with pressure short-term free cash flow. Longer-term free cash flow conversion has trended lower due to increased investment cameras. Post-Davis contract loss, Verra lowered full-year free cash flow guidance to 140 from a higher, reflecting the higher margin commercial services revenue from a prior. So they're going to lose 150 million in revenue, and they reckon they're going to lose 10 million in free cash flow. Am I getting that right? It doesn't seem to add up, does it? The numbers ain't numbering. Let's have a look. Where was it? Okay, so I was trying to figure out the business, which we know, right? We understand the business. Reduces revenue by 100, we'll say 145, 150 million. So they're going to lose 150 million in revenue. We'll lose 145 million in revenue, but only 10 million in free cash flow. Seems unlikely. The numbers ain't numbering, are they? If that's the case. You're right to be sceptical. Losing 100 on high margin commercial service revenue should have a much larger impact on free cash flow and a modest 10 million reduction in the full-year guidance. This aligns with 60% margins in commercial services. The lost revenue, extremely high margins. 83% of it drops straight to the segment profit. Prior guide not explicitly restated in every release, but the overall cut implies net free cash flow impact. How can that be? If it's a high margin business, even at 60%, they should be losing more than 10 to 20% free cash flow. 4 months of revenue, okay. Okay. I can't argue with that, but that's still a third. What is 60%? So that's 87 million divided by 3, because it's 4 months. They should be losing something like 30 million, not 10 to 20. saving, I don't know. I don't believe that, to be honest. I'm skeptical of that. I don't really know what to do now because day sales outstanding's gone up to 130 days from 107. Day sales of inventory is way up, but they say that that's because there's a backlog in putting cameras up, so day sales of payables is way up as well. That ain't right. How can you go from COGS of 118 to 24? That don't work either, does it? Let's try and figure this out. Where? Cost of revenue is wrong, in it. 24 million. Cost of product sale, this is a quarter. Ooh. Let's have a look at what they've got. Financials. Just take it from here at the moment. Cost of revenue 78. What was it last year? 75. What have I got it as? 118. Ooh. Okay. Okay, we'll ignore that payables thing for now. It's not overly important towards what we want to try and do. I don't know what the likelihood is that they're going to lose even more revenue than 800 million. We can do it on what it is now. Put 20% free cash flow margin in. 20% of the 3-year average free cash flow margin will give you 101 million free cash flow. What was... Oh dear. What's the market cap at the moment? 600, but you've got billion more than that in debt. Oh, this does not look good now, does it? The debt probably would have turned me off initially as well anyway. I wanted this to be better than it is, but you know, the universe does not work like that, especially in investing. What am I trying to look for now? Debt schedule. The debt schedule. Long-term debt. Amended term loan. 900 million maturing in 2028. Well, they can't afford that, can they? So that is going to be refinanced. Yeah, it will be refinanced, I'd imagine. They earn enough revenue. Government contracts as well, probably pretty solid. 2021, that was mine. 2025, the term loan. As a result, total principal outstanding was as of March. Right on them. Senior notes, they've got notes as well. Are they in here? No. Ooh. Show results. Nothing, right? Well, I can't see any, but they have got notes. Right, on them. Let's just do this. Look, you can do this. Copy and paste. Hopefully it works out. Explain the debt situation to me. Just copy and paste the whole bloody thing in, see if it works out. Amended term loan is a manageable, well-laddered maturity profile, moderate leverage, so Total gross debt. Senior note, 5.5 fixed coupon. 350 million matures in 2029. Doesn't say when that. Oh, matures 2032. Well, I mean, it's not the end of the world, is it? But it's still pretty tight. What have I? Interest coverage ratio is only 1.4 as well. I don't particularly like that. Refinance in October 2025, extended maturity from 2028 to 2023. So they've already refinanced. Obviously, that was before everyone thought they could lose almost half of their business if the other two follow suit, if Hertz and Enterprise follow suit. Repayment flexibility of temporary 1% premium refinanced early. Senior notes, fixed rate, unsecured, redeemable, callable, premium until par, revolver, 26 million drawn. Asset-based borrowing. We haven't really got a lot of assets, have they? Because we've got negative tangible book. Overall financial health, net leverage 2.5, no near-term maturities, debt to fund operations, growth investments, and shareholder returns, buybacks. That's another thing I haven't checked, actually. Okay, well, 3 years running, it's gone down. Share count. Oof. Honestly, I feel like I've probably seen enough. We have got another year. But you better bet that Hertz and Enterprise are watching Avis and thinking, let's see how it works for them. What are they doing? They may even be bloody talking to each other and trying to figure out what they're doing. Oh, that was such a drop as well. I was hoping it wasn't going to be a bit better news than that. Got another year. There's another year until the other two potentially follow suit. Oh, I'm going to keep this one on the radar for sure. It'd be very interesting to see what goes on with it. Oh, I want to keep an eye on this as well over the next couple of days to see if they buy. I feel like they've got to now. I feel like they've got to show there's confidence in it, even if that's a lie. If they're not, then that's very, very telling for me. If the insiders don't want to own it, what is? Oh, wrong bloody one. Hang on, what will be on over here? Let's go back, see if we can find. Where are we going? Verra mobility. Here we go. Right. What is beneficial ownership? Only 1.27%. Oh dear. Oh dear. That's where we're at. What is in the balance sheet then? The debt's fucked it, and it really is, to be honest. That I hate. Hate it. Fucking that as well, look. 800, what's that, 900 million. Over half of the assets are goodwill and intangibles. What is the goodwill? Where is it? Is there I'm sure I've seen a breakdown of goodwill. Here we go, goodwill and intangible assets. Let's have a look on this. Make it make sense. Make it make sense. Trademarks, customer relationships, which now that has taken a significant hit, hasn't it? They've lost 10% of revenue, so that is going to go. debt now as well. Asset-backed debt. Oh, I mean, you can't. What have they got? $1 billion in it? Is it asset-backed debt? Where was it? Sure said that it was asset-backed. Or have I made that up? Because they haven't got enough assets to cover it at $1 billion. I'm sure I bloody read it as asset backed. Maybe I'm going off my head. Because they've not got enough assets to back it. Ooh. No. Oh, asset based revolving credit facility. Okay. So maybe it's only the revolver that's asset based. Is that right? 1, 2 revolver. Okay, the revolver's asset based. They have got enough assets for that. This is starting to look very sticky for them, isn't it? I've got to be honest. PP&E, 225 million, depending on what that is as well. Doesn't say. Where are we? Doesn't say. That's annoying. Control F. Property. Oh, well, something might have been said there. No, property. Just there. Don't break down what it is. Okay. Oh. All right. Let's finish this up, unfortunately. I don't think it's even worth doing a discounted cash flow because it's 1.7 billion in debt that's now going to be heavily scrutinized. If they're going to lose all those revenues, stuff could get really bad for them. Especially if the other two go, Jesus. Pabrai reckons. Pabrai. There we go. Not Pabrai. He doesn't. Okay, I'll take that back. He doesn't. I have a metric that values, just does discounted value. I've called it a Pabrai one because it comes from his standard investor book. But it's basically discounted cash flow. And instead of adding the asset base to it, the tangible asset base to it, which you can't do in this because it's negative. Pardon me. Pabrai sell would do discount cash flow and then sell the business for a multiple in year .5 or 10. So basically all I've done is that the discounted cash flows plus the business value would give 800 million. But it's not that because you're going to lose a lot. Joel Greenblatts multiples. I've got a multiple analysis one as well. Look, where that's using 80% of the free cash flow margin, even though I think it's going to be significantly hit. Future simple free cash flow around 92 million a year, which is obviously way above what's just happened, but that's under normalized circumstances. 90, it's around 90 anyway, but honestly, no. I think I've seen enough. Unfortunately, it turned out to be potentially a shit show. But, you know, we looked into it. We've seen it, done a whole video on this one company. First time I did, dove that deep into something in a little while, so it's good to grease the old gears and make sure you're on top of it. Another business I want to look at, I'm not going to do it today, I'm not going to do it now, it's EasyJet. Because I've seen the it doesn't matter, it's gone up. But then I've seen that someone potentially offered to buy out EasyJet, is that right? I've seen Castle Lake in early stages considering EasyJet offer. Now for asset-based lending is in early stages considering a possible offer for EasyJet. The firm said no approach has been made to the airline's board and noticed recent speculation regarding armed aviation lending business merit. Because EasyJet, I think, own like 80% of their aircraft, so they've got quite a lot of asset backing. Okay. Maybe EasyJet on the next one, but VRRM, I think, unfortunately, is a no-go. Unfortunately. One of the other things I just want to ask. Do they have any competitors? Just to see. Faces competitors across all three segments. There is a leader in several niches, but the markets are fragmented with both specialized players and large diversified firms. Held a leading, often dominant share in the US. Rental car violation. One of the largest providers in the US of parking solutions. Largest software parking technology provider in North America. So they are pretty scale end-to-end management. Okay, threats, customer service, especially AI. There we go, especially to the rental companies. Aggressive bidding on government contracts. So stuff I would imagine often goes cheaper than they'd like it to. Larger diversified players or broader offerings. Okay. I just think with this debt load in, things have the potential to go really, really bad. Because they're renewing in whenever it was is now. You think you could lose another 300 million in revenue before then. And that's the highest margin revenue as well, the highest profit margin revenue. One to watch, but I think it's one to stay out of, to be honest. There's too much risk there going forwards. And I'm not comfortable enough in my abilities to discern that it's cheap. It doesn't look cheap to me, to be honest. I mean, it does. It looks cheap currently, but the risks are huge. Yeah. Okay. All right. Well, thank you very much. I hope we learned something there, and I will see you on the next one. All right. Please like and subscribe, and thank you very much. Goodbye.